Hi guys, today I'm going to be talking about your pension options in retirement, covering all the main ones. I can't cover them all because there's too many to go through and we don't have enough time. But if you would like more information around your pension and your retirement, then head over to our website at inflationmedia.co.uk and head over to the At My Retirement section where you can find videos and blogs that can help you in your retirement. However, if you're still unsure, then get in contact with us and we'd be happy to help. So, you've reached 55 and you've heard the rumours that you can retire. Great. But what does that look like and what are your options? Today, let's look at two scenarios and go through the options. So, scenario 1, let's say you have a personal pension that you've been saving into. And let's say you have 100k in your pension. The first option is to leave it where it is and not touch it and carry on contributing. Just because you're 55 doesn't mean you have to take it. Option 2. Buying an annuity. You could buy an annuity, which means you hand over your pension pot to an insurance provider that provides annuities. In return, they will pay you an income for the rest of your life. Now, the amount you receive will depend on what annuity rates are at that time. They also depend on your current health, as the insurance provider is taking a risk by paying you an income for life. The more healthy you are will actually lower your income, as you would be expected to live a bit longer. The income you receive from your annuity is taxed at your highest marginal rate. Now, if you were to die, the annuity provider pretty much keeps your money because you've handed it over them in exchange for an income for life. They may pay a spouse's pension on your death, but that's generally around 50% of what you were receiving. So all that money that you've worked hard for throughout your life and what you've saved would now be gone. Due to this, and also low annuity rates, more and more people are choosing a new option called FAD. So FAD stands for Flexi Access Drawdown. This was created by the government to give people control of their pensions. With FAD, you can take 25% of your pension tax-free from 55, or parts of your tax-free cash if you don't require it yet. Whatever is in your pot is still invested, and you can choose how this is done. You could, if you wanted, to have part of it or all of it in cash for extra security. You can then start to draw down your pension. How much you want and when you want is really down to you. Remember, all pension income is taxable at your highest marginal rate, so you can tailor your income to avoid entering an extra tax bracket. Now, if you were to die, whatever you had left in your pot can be passed down to your spouse and beneficiaries. The third option is UFP+, which stands for Uncrystallised Fund Pension Lump Sum. With that, you could take the whole pension pot and effectively cash it in. You would get 25% tax-free cash, and the remaining would be taxed at your highest marginal rate. So if we go back to our pension pot of 100k, you would receive 25 grand of tax-free cash. The remaining 75 grand would be assessed for tax. If you had no other taxable income in that year and you cashed in the pension, you would have £12,500 in your personal allowance, so there'd be no tax on that. The next 37,500 would be taxed at 20%, which is 7.5 grand, and the remaining £25,000 would be taxed at 40%, which is £10,000, and that would be a total tax bill of 17,500. Depending on your situation, there may be a very good reason to do this. However, taking financial advice could avoid an unnecessary tax bill. Option 4. You could, if your pension scheme allows it, combine the earlier options we spoke about. So you could take your tax-free cash, use part of your pension to buy an annuity, and use the rest of the pension to access Flexi Access Drawdown, so you can leave something to your loved ones on your death. Now, you can only do this if your current pension scheme allows it, as some do not, and you would have to transfer to another pension scheme that can give you 100% access to all of these options. Some only give you an option of an annuity or UFP+. Now, let's look at scenario 2, final salary pensions, which are also known as defined benefit schemes. If you have one of these pensions, you would have been a member of a workplace pension scheme. With this, it is down to the company that you worked for, or still do, to fund the pension, and it's their responsibility to meet the expected value of your pension in retirement. There are normally rules relating to when you can retire, so retiring at 55 might not be an option. With these pensions, the scheme will provide various options that you can take in retirement. Generally, these are an income for life and a PCLS, which stands for Pension Commencement Lump Sum, or you could take a lower PCLS and more income for life. The PCLS is a tax-free part of your pension that you will receive. And again, the income is taxable, and again, like an annuity, if you were to die, so does your pension. Although, if you had a spouse or beneficiaries, they could receive up to 50%, but that depends on the scheme rules. It's different for each one. Thanks for watching, guys. Again, if you need any more information, please get in contact with us and we'd be happy to help.